Stocks trade ranged after US and China agree on a trade framework, but China's curbs on exports to India are a new bother. Oil and gas stocks are the big gainers, while FMCG drags.
China's curbs on rare earth magnet exports are starting to pinch, with Maruti Suzuki likely to push back the launch of e-Vitara. The auto major has also trimmed its output target for the model till September.
Maharashtra has raised excise duty on Indian-made foreign liquor while keeping the levy on beer and wine unchanged, sparking big moves in stocks. The state has also introduced a new category for liquor made locally.
US and China reached an agreement on trade after high-level talks, and the negotiators will now seek approvals from Trump and Xi for implementing this, based on the Geneva framework. Well, hello and welcome to the halftime report live from the CNBC TV18 Motilal Oswal studio. I'm Vivek, and with me today is Mangalam. Good morning, Mangalam. You've had a very busy morning, but irrespective of all of the news flow, the good part is all of the four indices that we track closely are in the green. The Nifty well above the 25,200 mark. The Nifty Bank, after yesterday's brief breather, is once again back to winning ways. Mid-cap and small-cap index largely flat, but with a positive bias. So overall, not much to complain about, but you've had a very busy morning.
Yes, not much to complain about, barring, some of these alcohol spirit companies, which we'll talk about in detail later during the show as well. But it's actually quite a good day for the bulls if you look at it. Over the last three trading sessions, the Nifty has been making higher highs, and right now as we speak, Nifty has crossed yesterday's high of 25,199 as well. Those are a couple of stocks which are under pressure right now, but just look at the Nifty, it's moved higher. And the good part is yesterday's up move was led by the IT stocks. Before that, it was the banking index, and today now we have the energy stocks which are backing or batting for the bulls. So pull up Reliance. It's the top contributor on the way up for the market right now, and Reliance as a stock is at a near 8-month high. So just keep an eye out on that. The other couple of stocks which are doing well, Wipro's moved higher. So IT stocks continue to hold well, even as the Nifty Bank gains about 100 points. The broader markets, even as the mid-cap index at an index level is flat, and a large part of that flatness is because of the underperformance that we're seeing in the Alcobev companies. Look at the advanced decline ratio, and that would tell you that portfolios are feeling a lot better today than what they were in the last few trading sessions. We have 1,800 stocks which are in the green versus about 740 stocks which are in the red. Among the stocks which are in the red include the Alcobev stocks, particularly United Spirits, and we also have a big gash that we're seeing on Radico and Allied Blender. So let's tell you what exactly is taking place out here. Overnight, we had the notification coming from the Maharashtra government where they've increased duty, excise duty on Indian-made foreign liquor from 3 times of production cost to 4.5 times of production cost, basically undoing the benefit that happened with the India-UK free trade agreement on a slash of duty on bulk import of scotch. But at the same time, the excise duty on country liquor has increased by about 14%. So Indian-made foreign liquor increased by 50%, country liquor increased by 14%. We have a new category of grain-based foreign liquor called Maharashtra-made liquor, which has been approved. So only liquor manufacturers located in Maharashtra will be able to produce this type. So that gives a boost to the local producers here. Put all these together, what does a 180 ml bottle of alcohol cost in Maharashtra? The minimum retail price for country liquor would be 80 rupees. Maharashtra made would be 148. Indian made foreign liquor would be 205, and a premium foreign brand would be about 360. So this puts a bit of a dent into companies which are looking at IMFL and premium foreign brands as a strategy to grow itself. And that, for United Spirits, accounts for 20-22% of sales, Maharashtra alone. And Radico Khaitan, 7 to 8% of their sales come in from Maharashtra. So analysts believe, all things considered, this could be an impact of anywhere between 6 to 8% on United Spirits and Radico Khaitan by 2 to 3% on an EPS basis. But remember, this also will be a little lower because of the benefit that the India-UK FTA would bring on scotch imports. There are 3 stocks, however, which are spiking as we speak. We have GM Breweries. The street expects the company to benefit from the introduction of the Maharashtra-made liquor category. They will have to re-register brands with the state, but until that happens, they have a fair amount of headroom. So this stock is doing well. Secondly, United Breweries is not falling as much. In fact, for brief periods was in the green as well, because the street expects shift from spirits to beer at the premium level, something that United Breweries has been pushing as well. No increase in duty in beer. And finally, we have Sula Vineyards. That too is high single-digit sort of gain coming in on that stock because one, wine is not mentioned in the excise duty increase. Secondly, Maharashtra, the largest producer of wine in the country. And third part, the stock already has seen a 40% correction from its all-time high. Last 4 quarters have been very weak for growth for Sula Vineyards. So let's see whether going forward, this duty would shift some consumption into wine, and that stock stands to benefit from that.
Thank you so much, Mangalam. Neatly breaking down a few gainers, few laggards. But if you're a drinker, you definitely have to shell out more.
Well, I am not a drinker, so I'm okay. But the unfortunate part is that it's not just alcohol. Because the flush season, every monsoon, price of milk increase as well.
Right.
So for me, for those who drink alcohol, yes, it is getting expensive. But for those who drink milk as well, 1 to 2 rupees per litre is increased.
Inflation across the board. Well, thank you so much, Mangalam. Well, moving on, a Reuters news break reveals that Maruti Suzuki's big launch for the year, the e-Vitara's production, may be delayed on the back of the rare earth magnets crisis. Parikshit joins in with more details on this front. Parikshit, over to you.
Well, yes, we hear that the big e-Vitara launch, which was the big product launch that Maruti had showcased in January at the Auto Expo, and it was supposed to hit the Indian roads sometime in July and August. That launch is possibly going to be delayed. The export plans may also be delayed because of the rare earth magnet crisis. What we are learning that Maruti Suzuki, and this is what CNBC TV18 has independently verified, that Maruti Suzuki initially had a plan of making 88,000 e-Vitaras in the month of April, and this was for the entire fiscal year FY26. That plan was later reduced to about 67,000. The plan was to make around 25,000 vehicles between April to September out of the larger 67,000 target. That plan has been slashed further to 8,200 vehicles only till September. This is because they do not have enough rolling inventory of rare earth magnets, which are a critical part of electric motors which go into EVs. Having said that, Maruti Suzuki sources tell us that they are still hopeful of meeting the full year target, and whatever production has been lost between April to September because of the rare earth export issue, it will be made up October onwards. But overall, it seems that the export of the e-Vitara, the India launch, all of that could be impacted because of the rare earth crisis.
Well, thank you so much, Parikshit, for joining us, giving us a sense of how exactly the rare earth magnet crisis is impacting production across OEMs. Well, the other stock in focus today is Tata Communications. It's under a bit of pressure. This is post the analyst call that the management held. Prima joins in with more details.
Thanks so much for that. So there are 4 key takeaways. One is that the data revenue guidance of 28,000 crore of revenue has been pushed forward by 1 year, from FY27 to FY28. But this doesn't come as a surprise because anyway, going by the current run rate, it was pretty challenging for the company to achieve that guidance by FY27. So in that context, it's not a surprise. Secondly, on the margin front, what the company did say is that there's one portfolio, the digital portfolio. It's been loss-making. Last year, 900 crore of an EBITDA loss. But eventually, their aspiration is that they want to hit double-digit revenues, margins in the digital portfolio. So that's a positive. Third, they spoke about asset monetization. Remember, they have a data center business where there is a JV, they hold 26% stake, they're sitting on land bank. They're saying all that takes time, but eventually when it happens, it will be enough to offset any adverse outcome of the AGR dispute. And finally, remember the company has made a lot of acquisitions, Kalera, Switch. That's the reason why EBITDA margins for Tata Com have also been under pressure. They're still open to more M&A because they've managed to bring their debt to EBITDA lower over the last 2 or 3 years. So they're open to M&A too. Back to you.
All right, we take that point, Rima. Thanks a lot for that. That's about Tata Communications, lower by about 0.25%. But let's slip into a short break. And as we do that, let's get you to step into a world where insight meets influence. CNBC TV18 Access. It's a membership-only platform which offers users premium content, strategic market intelligence, and access to the minds shaping India's economy. From behind-the-scenes interactions, you get priority access to CNBC TV18's flagship events. Gives you studio access as well. And you get master classes, elite lifestyle perks. And this is more than just a membership. It's your front row seat to the future of business and growth. The power of insight, the privilege of access and exclusivity, experiences and influence. It's all yours to claim. Become a member. Log on to cnbctv18.com/access/plans. Let's take note of a few stocks which are moving higher right now. PI Industries is the one which has moved to the high point of trade. Another stock which is doing well actually has recovered from the lows is Biocon as well, currently at the high point for that counter too. So PI Industries, a sharp spike is what we've seen. Biocon is the other one which is at the high point. And we're seeing some traction in names like Vishal Megamart, which too has moved off lows, fairly off lows in fact, at the high point for that counter. And High-Tech Pipes is the other one which is gaining almost 5% right now. Decent volumes backing that one as well. But from micro, let's move on to a macro. And it's an important MSCI event that is upcoming. In the expected 2025 annual market country classification review, could there be any implications for India? Vivek joins in. Vivek, you've been telling us how they're considering whether to put South Korea into the developed markets or not. Were that to happen, what happens to India?
That's right. So, that's the key talking point. 24 June 2025 is when MSCI will take the call. Will South Korea be reclassified as a developed market? It's currently classified as an emerging market in the same category as India, as well as China, as well as Taiwan. This has been in the works for quite some time. MSCI has been considering this for quite some time. But there were concerns related to South Korea. What were the concerns? Number one, they were not eligible or they were not meeting certain criteria, including criteria related to, ban as far as short selling was concerned. Now, as of March 31st, 2025, there is no longer a ban in South Korea on short selling. So that is one key tick mark as far as South Korea is concerned. Timeline for the event, it's expected to be implemented post the announcement in the next 1.5 to 2 years. So it is an event that will take a certain amount of time to be implemented, given the fact that the implications of this particular development are quite significant. Now, why are we tracking this event? What is the implication for India? First thing that we need to understand is, as far as the MSCI Emerging Market Index is concerned, South Korea has 10.4% weight when we last checked it. So reallocation of the money, of EM money, will go to the other constituents within the MSCI EM, and some of the other constituents include names like China, Taiwan, as well as India. Now, in case this were to happen, there is a twofold implication as far as Indian equities are concerned. The first implication, of course, is the kind of positioning that active funds will take ahead or immediately post the announcement. That is a little tough to quantify. However, when you're talking about passive funds or index funds that do track the index provider as is, we do have a sense of the quantum of flows that India could witness. And this is a significant quantum. Expect inflows in the range of $11 to $12 billion. Now, this particular number is an analysis or an estimate by IIFL Capital. So, a significant inflow event where India were to get and be the beneficiary. But what we need to keep an eye out for, in the past, MSCI has deferred, upgrading the status of South Korea. And secondly, what's actually happened is that it will be deferred, at least the implementation will happen over a period of time. So maybe 7 to 8 quarters is when we will see slow inflows coming in. Nevertheless, a positive event in case it were to happen.
All right, Vivek, thank you so much for explaining that. A positive event if it were to happen, and if it did happen, $11 billion do not come directly on one day. It comes over 8 quarters itself. But what's doing well are a lot of these oil marketing companies and some of these upstream companies as well. Sudarshan joins in to decode what's fueling this surge. Sudarshan, typically we see OMCs rally when the upstream companies aren't rallying. Today it's both of them are moving in tandem. ONGC has moved higher, Oil India has moved higher, Reliance has moved higher, and all the oil marketing companies are higher too.
So it's an all-round gain that we are seeing in oil and gas space, and for Oil India there was a positive brokerage note. But for OMCs, there is an outlook that has come from US oil body that is known as Energy Information Administration, which had released outlook for the short term, that is for 2025 and 2026. And it believes that in 2025 and also in 2026, crude is expected to move lower. Remember, in the month of May, the average Brent crude price was $64 per barrel, which was down of almost $4 per barrel if you compare from the month of April. Now, this oil body like OPEC or IEA, it believes that crude in 2025 is likely to end at the $61. And it may fall further in 2026 and may settle at around $59 per barrel. And it's on the back of rising global oil inventories, which, as per this oil body, which is known as EIA, is going to help, or basically going to make sure that, not make sure, basically which indicates that crude will be falling further in both the coming years that we may see.
Well, thank you so much, Sudarshan. the sector, oil and gas, today for a change, both producers as well as the marketing companies, all of them doing quite well. IRCA, HPCL, BPCL, all of them moving higher in the session. Well, it's now time for a short break. Pritesh Mehta, Executive Vice President of Yes Securities, joins in with some trading strategies on the other side. Stay tuned.
Watch out for a few of these life insurance names. You have ICICI Pru, which is spiked to the high point of trade. All these life insurance names had been doing well all through today, but we've seen an incremental spike come by. The other one is LIC. That's the one that should come up for you as well. Up around up around at the high point of trade, and 0.6% have come in terms of gains in just the last 15 odd minutes or so. But if you look at the markets on the whole, and equated with the way the FII or FNO data is right now, we have the Nifty Bank, both of them doing well. The Nifty's crossed yesterday's high at the high point of today's trading session so far. At an index level, the mid-cap index is lower, but broader markets are a lot better. If you look at Reliance, that's the one that is at an 8-month high, the top contributor to the Nifty in terms of gains today. And alongside Reliance, it's all the energy stocks, which Sudarshan just spoke about moments ago, which have been contributing to the overall health of the market. So ONGC, Oil India, both the upstream companies or the downstream refiners, we have BPCL and HPCL doing well. If you look at the advanced decline, that tells you that portfolios are feeling a lot better today. 1,800 stocks in the green for about 743 in the red. And barring the first hour of volatility or so, it's been pretty much a straight parallel train track, which tells you that the strength of the market is good, alongside the decline that we've seen in India VIX, which after falling below 15 2 days ago has fallen below 14 now. So put writers are fairly active. Where are the put writers active? 25,100. So the support for the Nifty is moving higher as the market inches higher. 25,200 puts are also seeing a fair amount of traction, telling you that the support has moved higher from 25,000 to around 25,100. Though on the way up, 25,250 call is still fairly active, premium of 60 rupees, telling you that the market faces some supply around 25,300. But if this were to break, then there is a further up room for up move, and that's visible in the 25,500 call. Moments ago, this was just around 10 rupees, fairly well bid, a lot of punt buying taking place out there. In, just a bit, it's increased by 10%. Today, it's up by 50%. So those option buyers making a fair amount of money. In terms of individual stocks, watching out for United Spirits, a lot of short positions being added on it, and we've explained the reason why too. But CDSL is one of the stocks that I'll watch out for very closely this evening, because it may enter FNO band. Remember yesterday we had spoken about IREDA and RBL Bank having the possibility of entering FNO band. That's happened. Today, I see that happen in CDSL.
Well, very, very interesting. CDSL is the likely candidate you're predicting that could enter the FNO band. Of course, based on data.
Of course, based on data.
Well, like we promised, Pritesh Mehta, Executive Vice President of Yes Security, joins us on the show. Thank you so much, Pritesh, for joining us. First up, what do you make of the markets at current levels? Nifty comfortably above the 25,200 mark, and we sustain the rally.
Yeah, good afternoon. Now, see, this week is all about follow-through moves. Nifty had a breakout in previous week's trade after days of consolidation. And rather than witnessing retracement, what we have seen is a gradual move on the upside, which it is really good to see. And even broader markets are displaying similar trends. So we have a scenario where broader markets and something like small cap index is up by 2% so far this week. Mid cap is up by 1.2% this week. So yes, whether it's Nifty, the broader markets, everything is moving in the same direction together. So in this kind of scenario, I think what we can do is ride the wave. No need of questioning it, no need to doubt it. But whether it's in mid-cap IT, whether it is commodities, recently we have seen oil and gas stocks moving well, doing well. So there is rotation being seen from the the large cap space. Something like we have seen the likes of banks doing well, financials doing well, the top heavyweights name. But now it is going to sub-sector theme. So this is a welcome sign. I think this momentum is going to continue.
All right, momentum is going to continue. What about individual stocks? Where are you betting today?
So there are two stocks that we like. The first one is Biocon. Now see, we have a slightly negative view on the pharma space with the ratio of pharma versus Nifty is on the downside. But this particular stock is an outlier. It is outperforming the pharma index. When we look at the pointer figure chart, we are witnessing the bullish anchor column which was formed in the month of April. Thereafter, we are witnessing follow-through moves on the upside. So buy for a target of 385. The stop loss would be around 335. The second recommendation is buy LIC Housing Finance. Now it is attempting to surpass the downward sloping 45-degree trend line drawn off the peak of June 2024. Once it sustains about 625 in next couple of days, we can see renewed uptrend taking place. And it has already confirmed a bullish shuttle break. So buy for a target of 720, and the stop loss would be around 590.
Thank you so much, Pritesh, for joining us, giving us a sense of how exactly you expect markets to trend, as well as your individual trading ideas. Well, we now slip into a short break. We will be back with Manoj Menon, Commercial Director of Kantar World Panel, on the other side. Stay tuned.
If you look at the sectoral indices today, it's the FMCG sector that stands out in terms of its underperformance. It's down about 1/3%. At a time when the Nifty is up by 100 points, all the other sectoral indices are doing fairly well. Metals, IT, infra, name whatever. Why is it that the FMCG sector is not doing so well? It could be perhaps because of this report, which suggests that urban India's shift to unbranded good outpaces branded FMCG growth. And even as macro improvement has taken place in the sector, it hasn't related in or translated into FMCG growth. FMCG purchased growth grew by about 3.5% in the first quarter of 2025. That's the fourth quarter FY25. And it's the slowest that we've seen since the fourth quarter of calendar 2022 itself. So growth still lags the sector. Manoj Menon, who is the Commercial Director of Kantar World Panel, joins in now. Manoj, thank you so much for joining in. There's telling data, right? FMCG growth at just around 3.5%. Growth split, while it's higher in urban India, lower in rural India. If you look at the listed brands, they've grown much slower in urban and much higher in rural. What does this sharp divide in rural and urban tell you about the consumption environment and what people are preferring?
Thanks, Mangalam. Thanks for having me here. So there's one big divide when it comes to urban rural. I think rural, what is driving the growth is more from essential and some of the snacking categories. So for example, if you look at, say, soaps and hair wash and utensil cleaner kind of categories growing pretty well in rural. And also some of the snacking categories like, say, noodles and salty snacks, which are doing very well. So the aspirations and the experimentation is very similar to urban, but the rural consumers are actually sticking to the essentials, but also adding to their bit of snacking to their basket, which is what driving the rural growth. And as you rightly said, the listed companies' growth is much higher in rural as compared to urban. And urban consumers, bit on the other side, where having the heat on the inflation more. Actually, while we all talk about the inflation being moderate and playing around 4-ish on a month-on-month basis, and the predicted one being 3.7. But what we also need to understand, we're living in an industry where the food inflation is still high. I mean, it kind of yo-yoing. Actually, in some months it comes down to around 3%, sometimes goes up to 11%. So that's actually having an impact on the urban consumers more. Actually, therefore, I mean, there's a kind of trade-off happening in the urban consumer set.
Are you trying to say that there is still an impact of inflation on urban consumption, and that explains the shift to unbranded because, branded is now getting a little more expensive even as rural maintains its, consumption levels?
So that's what you're seeing actually, because in many categories, the unbranded growing faster. I mean, be it mostly in the staple categories, but not only staples, even a snacking category, which is big on unbranded, which is the Indian namkeens, which are the unbranded ones, which is growing faster. While listed companies are managing to convert consumers from unbranded to branded, but at the same time, unbranded is also growing. So I think it's a bit of a tricky situation for for the consumer. I mean, or from a manufacturer standpoint, getting one is that you're converting consumers from unbranded to branded. That's a strategy that most of the companies are following within the staples or snacking categories. But at the same time, pricing, of course, is going to be a big differentiator. And if there is a stress we've seen in the past where if things are going to be tough on an ongoing basis for a long time, and there could be a reverse shift that happens from branded to unbranded.
And just for bookkeeping, unbranded does not include D2C or private labels and all of that, right?
No. It's actually only the ones which are not having any brand attached to it is being sold as loose. and the consumer what is paid for is what we call unbranded.
Understood
Happens
that.
mostly in, say, edible oils and atta and salt, spices. So it's big, actually. I mean, in edible oils, I mean, the unbranded penetration is around 62%. I mean, in spices, around 40%. So it's not a small number from a penetration angle, because these are big segments that sits in those categories.
Well, the next big question is, as far as the listed, branded, organized space is concerned, when can we expect growth to return, or will players be forced to go ahead and tweak pricing?
Interesting one, actually. We do see what our forecasting, or the way we have seen markets so far from a data standpoint, is that I think this is probably going to continue for next couple of quarters. And there will be a recovery towards the last quarter of 25 is what we are seeing from the data science standpoint. And recently, we have just done one study to understand the consumer sentiments toward the future, because we are talking about improving macroeconomic factors, and also government is supporting on various things on taxation, etc. But we're still not seeing that reflecting into the behavioral angle. And even if that happens, we still don't know whether FMCG is really going to gain from that. So those are some of the areas that is not clear. But from a consumer sentiment standpoint, people are still skeptical. I mean, that's a recent report, as recent as 15 days back. We've just finished that study to understand the future sentiments part of it, but it's still people are holding back from a positivity standpoint.
So people are still holding back, and you don't see growth return until the fourth quarter of this year. But you also speak about data that you've cut across rural, urban, unbranded, branded, listed, and other branded, which is not listed. How have those trends played out over the last few years? Because a lot of experts that we speak to, they say that maybe, listed is not growing also because unlisted, but yet branded, are doing a lot better, be it private labels of modern trade, be it the D2C companies, be it ones which are quick commerce, exclusive, etc. So are listed players becoming less relevant as barometers of true consumption? What's your thought here?
So you rightly said, I mean, at some point, I mean, not even very far, I mean, once the COVID time, or even post-COVID time, I mean, the listed players had that trust, and, those brands continue to grow faster because people chose to select those trusted brands more than anything else. But things are now getting diluted, because now we are almost in the post-COVID era, almost 3 years down the line. We are seeing those smaller brands. You rightly said, not the unlisted, not the unbranded ones I'm talking about. I'm talking about even, for example, Joy in face wash. That's one of the fastest growing brand in face wash category. Even so as Mamaearth, which is growing faster. These were not in the top 10 list of clients. I mean, maybe a few years back. But I think they are now actually getting into the share, maybe the kind of innovation they're having and the kind of product portfolios that they're having, which is actually helping to grow those brands. So while the bigger brands still bigger, no doubt about that, because we can't really challenge their space in those categories. But those challenging brands are really growing much faster because they are far more agile and far more innovative in nature.
Manoj, when you're talking about quick commerce, it's been around for a while now. Does that increase overall consumption trends, or does it cannibalize from other channels?
So quick commerce is today, I mean, if I just talk about only top 6 metros, e-coms actually stands around 31% penetration today. That means 31% from an FMCG standpoint. E-commerce can be much larger when you look at other categories. And quick commerce is around 12% today. So from a top 6 metros. So while the consumers are all omni-channel consumers, because there are no only e-com buyers or only GT, I mean, obviously there will be a direct overlap with the GT consumers. So from a consumer level, there's a clear overlap. But from a spend standpoint, we are seeing a big shift in terms of expenditure when it comes to quick commerce. People are buying more premium categories when it comes to the premium is growing much faster when they're buying from quick com. But the only thing is, we still need to understand if the overall market is 100, I mean, quick commerce is still 12%. So the ability of quick commerce to change the needle today towards the extra spending is still limited. But of course, it's growing naturally. And now the quick commerce players are talking about growing down to the other pop strata. So I think if that happens, I mean, things can be very different.
All right. So let's look at the crystal ball now from here on. Last time 5% growth happened was in the first quarter of last calendar year, which is Q4 FY24. What is your prognosis for FY25 on the whole, or rather FY26 on the whole, and FY27? What kind of growth do you expect for the sector?
FY26, I would say it's going to hover around between 5.5%. That's the kind of growth that we're seeing. There are a lot of other pointers that we called out. I mean, whether rural monsoon was predicted is very good for this year. If those are going to happen, I think this can be an acceleration. But right now, I think it's going to be hovering around 5.5.
What about the next year? Do you think it improving beyond that, or
It will.
structurally growth has come down by a few percentage points?
No, I think it will improve in financial 26-27 is what our understanding.
To what? To what will it improve?
It will improve to around 6.2. I think that's the best we can think of at the moment.
All right, take that point, Manoj. Thank you so much for
Predict
joining.
a lot of things happening at the same time, but I think this is a possible number.
It's understandable. Too many moving parts. You'll have to, and too many moving categories as well, so to say. Let's see how this goes by. We'll, keep touching base with you periodically to understand where you are on the consumer sentiment and how your prognosis is tracking with real world itself. With that, we'll take a short break. And as we slip into that short break, here's some good news for you viewers. In case you missed this conversation, you can watch this on CNBC TV18's all-new app. Remember, it gives you instant access to not only breaking news, but in-depth articles and financial world updates, all of them at your fingertips. All you got to do is download the CNBC TV18 app from either the Apple Store, the Google Play Store, or just scan the QR code, which is there for you on the screen.
Welcome back to Halftime Report. Well, some very interesting news flow coming in at the bottom of the screen. Last week's big news, which was the Donald Trump-Elon Musk fight that kept escalating, now clearly seems to be awaiting. Elon Musk has now taken a conciliatory tone and has just tweeted. What does its tweet say? He says, "I regret some of my posts about President Donald Trump last week. They went too far." So clearly some scale back as far as the tensions were concerned. Remember, this has had significant implications. Number one, on Tesla itself, the share price of Tesla did see significant volatility in the week gone by. It fell almost 20-25%.
Right.
Has rallied a little bit from the recent lows. But despite that, this is something that street markets as well as USA itself will take a little positively.
They will take that little positively. It will be very interesting to see what happens because, when the Trump and Musk conversation on Twitter was going on and, the focus of Trump was all internal in the US. So all the trade deals of the world or all the trade-related uncertainty of the world was taken care of because of the focus being domestic. Now that domestic problems are being sorted, with Elon Musk actually backtracking what he said, will the focus be back on trade uncertainty over the world or not is something that we'll most definitely keep an eye out on. But what happens to the Indian market as a result of all of this with the levels at which we are trading? Indian market is approaching too expensive levels. That's not my word, that's not Vivek's word, that's the word coming in from Goldman Sachs' Sunil Kaul. He shared his take on cement and defense stocks as well. Let's hear out what he had to say.
I think the issue obviously remains that the valuations have kind of re-rated back to 23 times, which is expensive. And so we don't have as much upside at the index level for Nifty. So we have a 26,200 for Nifty, which is, I guess, 4-5% upside from current levels. And if you bake in currency appreciation of 2-3%, that's roughly around 6-7% upside in dollar terms, which is not bad given where the markets are. But we think it's kind of more a stock pickers market, more sort of alpha beneath the headline index. And that's where we are advising people to pick up stocks and sectors. In our allocations, we are underweight cement, we are underweight industrials. So we do have that strong preference of financial consumer versus the rest of the market. But we are sort of neutral on defense. So if there is one theme within that broader manufacturing industrials complex where we still feel that there is more to go, given how the geopolitics and the world is moving, that would be defense. So we wouldn't be sort of cautious on the defense names. I think there is more room for that to come through if that gets backed up by the government orders and all of that. But we will be probably more cautious on very highly capex sensitive sectors, which are more to do with sort of construction cycle, so to speak.
Well, clearly a preference there as far as the defense space is concerned, especially post-Operation Sindoor. Well, we'll now slip into a short break, but before that, some important updates for our viewers. Remember, you can stay updated on your favorite stocks with Money Control Super Pro. Receive real-time alerts with AI stock update feature of Super Pro and get insights on key corporate announcements on stocks of your choice for quick decision-making. Get your investment superpower today. Subscribe now.
Welcome back. 110 points higher on the Nifty. Strides Pharma is one of them, which is making big strikes right now, up around 6% as we speak, doing extremely well. And KPIT Tech is the other one, which has seen a big spike as well at the high point of trade. So a bunch of stocks doing well, but that's about our equity coverage. Let's get to Manisha Gupta, who joins in for all things commodities. Manisha, what do you have on your radar today?
Plenty.
As always.
As always. But Mangalam, it also is about the dollar index, which has seen a bit of a decline. It also is about the fact that you have the US inflation numbers coming in today, where headline inflation at 2.5 and core at 2.9 is what the markets are working with right now. But anything more and less, and that would impact the dollar index and, of course, various asset classes, including commodities. Well, let's put that question across then to Kishore Narne. He is Director, Head of Commodities at Motilal Oswal. Kishore, hi. How are you reading the US inflation numbers, and what's your sense on what those numbers could be and its impact on dollar index?
Morning, Manisha. I think, inflation numbers are better than what market was looking at, and that's where actually dollar also have slightly positive this thing. But at the same time, the rhetoric is increasing further that there should be a rate cut, and probably as we all anticipate, or most of the market is anticipating that this FOMC, they might keep the rates flat, but probably the next FOMC, they will be doing a rate cut. So I think that's actually boosting a little bit of risk sentiment in the markets, and that's expected to push up the risky assets, including the industrial metals as well as some of the equities across the board. I think the overall thing is I am expecting inflation to further soften, and I'm expecting, excluding the tariff impact, they might be forced to do a rate cut in the next meeting.
The other thing that the street is watching out for, Kishore, is clearly the US and China trade agreement conversations, and they seem positive as well.
Yes, I think it's mildly positive. I can say that because they have not come out with any big bang. So probably they have agreed on the framework of how the talks have to proceed from here, and what's the basis for their talks and all. And again, even that is subject to the approval of their respective governments. I think so. But it's a start at least, and it's something that the market will be looking at as a positive development. But again, if there is any negative news, if both the representatives go back to their respective presidents, and if there is any discrepancy there, and if the presidents don't approve this framework, then probably the market will go back into the tailspin. But keeping that in mind, actually today, most of the risky assets are getting benefited from that across the board. Though we are seeing a rally in gold and silver, I don't think that will hold at this point of time if that's going to be true.
So when you talk about the risky assets, and would you include metals in there? Because we've seen some support continue in case of copper. Also supporting copper is a backwardation, almost $1,000 a ton of a backwardation there. How do you read that?
Yeah, of course. I think, that's impact of tariffs also, because there's a lot of inventory built up happening, especially in the Western countries and US. There's a huge upfronting of the demand. So that's actually pushing up the backwardation. But I think, supporting, $1,000 was on the cards for some time. $970, $960 is something which would be $9,600 to $10,000 per ton is something what we are looking at. So anything close to that is going to be very difficult to sustain. But again, having said that, short term, both aluminum and copper are looking very positive, and if this talks between China and US progress a bit also, that will increase this positive outlook. So both aluminum, zinc and copper, I think all these three metals are looking positive. For today, anything close to 870, 865 is a good level to buy. On the top, it should be around 882, 883 is a upside potential.
Since metals are doing well, would you count silver within that, because it's more an industrial metal and less a safe haven now?
Yes, I think, of course, that's what we have seen in the last week or so, where the silver outperformance significantly dominated the precious metal segment. But again, $36 is where a little bit of breather is expected. Probably we can see some corrections coming up. Both gold and silver, I'm expecting a technical correction from here. So that's what I'm seeing. Probably today, both of these may not hold these gains. So towards the end of the day, there should be some dips coming up in both gold and silver. Anything close to 1,07,000 in India is where I would be looking at a short-term selling opportunity. Downside could be 1,05,500, 1,06,000, probably 1,000 to 1,500 rupees. Downside could be potentially possible. Gold also anything close to 97,400, 97,450 in Indian terms. I'm looking to short-term sell as an opportunity. Downside could be 96,600 odd levels, around 700-800 rupees levels. So though intraday gold is still looking positive, it had done a gap up today. But I have a suspicion these gains might not hold, and towards the end of the day, we might see correction in both gold and silver.
All right, we take that point, Kishore. Thank you so much for joining in and giving us your views on a bunch of these commodities. Manisha, thank you for taking us through with that conversation. With that, we are out of time on this edition of Halftime Report. The news that the Nifty is still holding with gains of almost 100 points. The Nifty Bank has trimmed some of its gains, but still holding with a gain of almost 80 points. Take your leave. Business Lunch takes all the market action ahead.